Hello and welcome to Unleashed, the show that explores how to thrive as an independent professional. I'm your host, Will Bachman, and I'm so excited to be here today with Jonah Gruda, a tax partner at Mazars, and we are going to walk through a comparison of entity types. So this is a question I get a lot, like what sort of entity type should I set up? Should I do an LLC or an S Corp or something else? Well, we have a sheet. The sheet that we're going to be talking about, you can download in the show notes that Jonah prepared for us, and we're going to walk through this sheet now. So, Jonah, welcome to the show.
Thanks, Will. Really happy to be here, and certainly back again on this really terrific podcast. So I'm looking forward to getting the opportunity to discuss this with you again.
Yeah, thanks a lot, Jonah. And I'll mention that Jonah was, I believe, on episode 56, where we talked about broader kind of tax accounting issues, and that's been a really popular episode. So definitely check that episode out. And if you want to reach out to Jonah, we'll include his contact info in the show notes. So Jonah, before we start going through each of these rows, I'll just orient people. So what I'm looking at is a table you helped prepare for us that has 5 columns going through 5 different entity types. And then there's, I think, 8 rows that have different characteristics that we're going to compare against those. So people, if you're listening to audio, you can imagine it. But if you are at your desk, you can download this sheet of paper. Before we go through each of the different kind of categories in terms of the rows, can you walk us through, Jonah, big picture, the 5 different entity types that we're going to talk about?
Yeah, of course. I'm happy to do that. I think it's important before I do that is really set the framework we're going to have this discussion is. I think the intent here is to have a general broad discussion on the 5 most common legal forms of business ownership. But there's something that we're probably not going to get into a lot today that certainly impacts this as well. And it's going to be the tax environment, right? We're not going to get into some of the major tax issues. A few years ago, there was a Tax Cuts and Jobs Act, which taxed corporations at a flat 21%. Flow-through income could potentially be taxed at a maximum 29.6% after you include this 199 cap A 20% deduction. We're not going to talk about that as much right now because that could certainly complicate the calculus, and we could probably do a whole episode just on the 20% deduction. So when we talk about entity selection, we're really talking about 2 types of broad categories of entities. We have what's called, flow-through entities, and generally those are your sole proprietorships, your partnerships, your limited liability companies, and in most cases, your S corporations. And then we have our corporate forms, which are C corporations, and then in some instances, S corporations when we're talking about certain states and cities. So the general discussion is really going to be on those 5 and the unique attributes that those 5 have, but they tend to fall into one of those 2 buckets. And so moving from, maybe I'll just kind of mention them from, ease of setup and maintenance to some of our more formal and more complex ones. And so if we're looking at the chart, all the way on the left, we have the sole proprietorship. And that's what most people think about when they talk about, I'm working independently, whether it's for a profit business or even for a hobby. I'm the individual owner of that business. There's no, legal protection per se. That owner then has unlimited personal liability for the business debts and obligations. In terms of tax reporting, the individual owner reports the profits, the losses on his or her income tax return on what's called a Schedule C. In terms of management, that individual is the 100% owner. They're responsible for all the business decisions that the entity makes. In terms of expenses and formality of setup, it's rather simple and inexpensive to create and operate. There's no special filings that you need, but if a business name is different from the owner's name, then you could register a different name as a doing business as. Even if you wanted to, you could request a tax ID number to then ultimately open up a separate business bank account. And I would always recommend clients do that, even if they're operating as a sole proprietorship, to have a separate business account with the separate name and potentially separate ID number. That way, that's just another way to establish the legitimacy of that business, even though it's established as a sole proprietorship. In terms of taxes, I mentioned it, everything gets reported on the taxpayer's individual tax return on Schedule C. That income, that net profit from that business, is subject to another layer of tax in addition to the income tax, and that's generally the self-employment income tax. And that is, generally speaking, 15.3% of the net profit of that Schedule C. Taxpayers do get to deduct 1/2 of that amount as a deduction. So not as a traditional, not dissimilar from whether a client was receiving a W-2 for similar activities in which the payroll taxes are withheld on their behalf. So the sole proprietorship is relatively easy to set up, easy to maintain, easy to manage. The taxation is rather simplistic, as well as everything gets reported on their individual tax return.
Okay, this is actually a little bit news to me here. So I didn't even know that you could set up a business checking account for a sole proprietorship without actually establishing formally an entity like an LLC. So that's news to me. I thought that you actually had to set up an LLC if you want to go to a bank and open up a checking account for that business. So that's news. Let's kind of go across the board across these 5 different entity types and talk about sort of each row. So the formation requirements. Sole proprietorship, you said no filing is required, so you don't actually have to go and form a sole proprietorship. So if you leave a regular W-2 job and you're now not employed, and then you get a project with a client, they can just pay you to you, and you don't have to set up an entity, and that would be a sole proprietorship. They're just paying you to your social security number, or it sounds like you could actually get a tax ID number, which I didn't know that. I thought you had to get an LLC in order to get a tax ID number. So I learned something.
Yeah, that's correct. And actually, the IRS makes it rather easy for individuals to do that on their own. It takes about 10 minutes. It's free. You go on the IRS website. The form is called the SS4 online. It'll ask you a couple of questions: type of business, address, some other biographical questions, and they'll spit it out on the web page right for you when you're done with the application. So no specific legal requirements on having a tax ID number. It's just another way to establish legitimacy for the business, and it's a great way to stay organized as well, keeping everything paid to the business versus your individual person separately.
Yeah.
And I should add, you could also do this while you're employed as well. You don't need to leave your job to do this. So if someone is gainfully employed and they're doing some contract work on the side, they're going to be reporting all their income and expenses on their Schedule C anyway as a sole proprietorship. Mm-hmm. So one doesn't preclude the other, and both can be done at the same time as well.
All right. So let's keep on with formation requirements and go across the board. So let's talk about partnership. So if you want to set up a partnership, what formation requirements are there?
Yeah, so this is a good question. I didn't break out the partnership more, but there's actually several types of partnership. Actually, you could almost say there's 3. There's what's called a qualified joint venture. There's a limited partnership and a general partnership. I'm gonna talk about the 2 most common forms of partnership, and that's the general partnership and a limited partnership. Let's start with the one most people think about when they think of a partnership, and that's really the general partnership. And that's an association really of 2 or more people in business. The partners then own a percentage of that business based on whatever arrangement they have. They're simple and inexpensive to create and operate. Again, if the name is different, you could register a different name with the state. there's no particular federal filing requirement, and a lot of times general partnerships don't need any state level filing as well. You could be deemed to be conducting your business as a general partnership if the activities of that venture are enough to give rise to a partnership arrangement between two people. The interesting thing about a general partnership is, again, both partners have unlimited personal liability. Each partner is personally liable for her own actions and the actions of the other partners and or employees. So that is something to keep in mind when we're talking about the general partnership. And usually when we talk about general partnerships, and they're not as common today as they were in the past, and I'll get to the second type, which answers why. Generally, you would have an agreement in place that explains the management responsibilities, what happens in the case of disagreement, but those are some good best practices. Now, the other form, which is much more common and probably much more favorable, is what's called a limited partnership. So you have the general partnerships, two or more people, where each person has unlimited personal liability. The limited partnership is just that. It's an association between two people, but there's one general partner and then one or more limited partner. So the general partner is usually, let's say, the person that has the intellectual capital, the person that has, let's say, the financial backing of the company. That one person, as the general partner, has unlimited liability. The limited partner, so the other members potentially, they're just limited. Their liability is limited to the amount of their initial investment, as long as they don't actively participate in the management of the business. So generally, limited partnerships are probably much more common when we're talking about real estate businesses, real estate consulting, where there's real fixed assets in the entity. But again, the formation is relatively easy. There's no federal filing requirements per se. There's potentially maybe some state level reporting. But to be a partnership, there isn't anything you need to file with the government to be in business.
So when we say formation requirements, you may not file with the government, but you would probably still have like a legal operating agreement that the partners sign, right?
So again, while not often required, if you don't, common law tends to govern, but most partnerships, both limited and general, would have, an operating agreement, a partnership agreement that details out, tax provisions, distribution provisions, allocation of income and losses, all the legal issues that, are commonly covered when, two or more people are doing business together. Now, in terms of tax reporting, it's slightly different from what we mentioned with the sole proprietorship. Both types of partnerships are what's called a flow-through or pass-through entity. And what that means is the form that the partnership files is what's called Form 1065. But that tax form doesn't pay tax per se at the federal level for that particular entity. Everything, the profits and the losses, are allocated based on the arrangement, but everything flows through to the individual partners. So they would get a Form K-1, which would have their share of income and deductions, both taxable and non-taxable items. And then that individual taxpayer reports their share of the activity from the partnership on their individual return, and most likely that gets reported on a Form Schedule E. So the sole proprietor, everything gets automatically reported on the individual's Form 1040 through Schedule C. The partnership, both general and limited, files its own tax return on Form 1065. The 1065 issues a K-1 to the individual, to each partner, and then that partner reports their share of the profits and losses on their individual tax return. So it's slightly different. And then the tax is calculated based on that individual taxpayer's marginal rate based on their income levels.
Okay, got it. So the partnership doesn't actually pay taxes itself. It says, okay, here is the K-1 for each individual partner, how much like they they owe. You hear about, I mean, McKinsey's a partnership, and often law firms are partnerships. Are they typically, in this category of partnerships, or are they some other entity type, but they just call it a partnership, right?
Yeah, so great question. Certainly beyond the scope. Well, I mentioned the three. There's also another form. There's also the limited liability partnership. There's LLPs and there's LPs. Again, Mazars is a partnership, right? It's a limited liability partnership, and so all the partners tend to have limited liability. But yeah, most professional service firms are structured as partnerships. Now, again, there's a bit nuance. Again, I mentioned there's limited partnerships where one person is a general partner. There's also the limited liability partnership, and I think maybe McKinsey is in limited liability partnership. A limited liability partnership is a structure that has no general partners. All the owners of the LLP have limited personal liability. So slightly different, some nuanced. Some states have exceptions to, how these entities can be managed. But a lot of times professional service firms are generally structured as limited liability partnerships.
Okay, so that's an entity, and that's an entity type that's not on our list of 5, right? So that's out of scope.
It's on the list in that it's a form of limited partnership. Everything else is the same, other than the liability issues. A lot of these corporate forms and these legal forms, the biggest distinction is how liabilities are treated. So again, limited partners don't play an active role in the business. Limited partners are not personally liable for debts. Limited partners face slightly different tax rules when it comes to self-employment taxes. Again, professional service firms tend to prefer the LLPs to general partnerships because of the liability protection. But in terms of taxation, it's almost exclusively the same between these types of different partnership forms, and that everything flows through to the individual. They're called flow-through entities or conduit entities, pass-through entities, because all the tax attributes from the income and expenses flow through or pass through to the individual partner. Okay. So while the additional other types of partnerships are not on this list, in terms of ownership, liability, tax management, expense and formality, they're rather similar with those broad categories.
Okay, let's talk about limited liability company. That's our third entity type. Tell me about the formation requirements for an LLC.
Yeah, the LLC is the one that everyone talks about when they talk about, I formed an LLC, I formed a business. And, it's interesting. The LLC is not codified anywhere in the federal tax code. It's actually a state. So LLC is an interesting construct. You don't have partners, you have members. The LLC is quite interesting in that you could accomplish a lot of the attributes of all this matrix with one particular legal form. The limited liability company could be owned by one member or multiple members. If it's owned by one member, it's called a single member LLC. If it's owned by more than one member, it's just considered a multi-member LLC. The liability protection is very similar to limited partnerships or corporations, which we'll talk about. Owners have limited liability for the debts and actions of the LLC. So your liability is limited, thus the name Limited Liability Corporation. Now, because the LLC is a state-level construct, generally speaking, there needs to be filing with the local jurisdiction and the Secretary of State. And generally, each state has their own requirements of how you establish an LLC, and those are generally codified on the Secretary of State's website. The cost requirements and the filing requirements are all different and unique. in terms of the requirements. So it really just depends on where you're doing business, where you are, where the assets are, in terms of what state is going to be the appropriate jurisdiction to file in.
Yeah, no, I get a lot of questions on that. So it seems that a lot of people will file it just to get it in their home state, which is sort of obvious. A lot of people will get it, will set up their LLC in Delaware. Can you give a perspective on, how you should think about what state to choose for your LLC? Does it have to be your home state? Why do people pick Delaware? Are there other states to think about using?
Great question. Again, I think that also that might be good for a longer episode. But generally speaking, you could file. You could establish the LLC in any state. Delaware is a great state to establish your LLC in, because their filing fees are generally smaller. If the business is not doing business in Delaware, all they have to do is file a couple $100 annual fee. I think it's $300. There's no local sales tax. They don't have tax on intangible income, so like trademark or royalties. Delaware has a flexible management structure in terms of the residency of the members and the managers. They do offer some anonymity. Other states have, much higher. So California and New York have franchise taxes. And so a lot of it is based on the level you pay is based on income, at least is based on where the businesses are performing services. So it really just depends on what you're doing, where you're doing it, and how you're doing it. But Delaware is one you hear about. Nevada, Texas. It really just depends in terms of the financial issues that each person's going to have, and how complex their individual situation is going to be.
Okay.
But you could establish it in any state. In terms of management, generally you're going to have what's called a manager managed LLC or member managed LLC. They're slightly different. I don't want to get into the legal nuances here, but you could have a non-member of that entity manage it. So if you and I were members of an LLC, one of us does not have to be the manager. Someone else could be the manager, or one of us could be the manager. The LLC is also what's called a flow-through entity as well. Even though we do file in the state, if it's a single member LLC, it's almost as if it's the same thing as a sole proprietorship. So there's no separate tax form at the federal level that needs to get filed. All the income and expenses flow through to the individual member on their 1040 through Schedule C, and it gets taxed just like the income from a sole proprietorship. If there's more than one member of an LLC, so let's say it's you and I, then the tax reporting is very similar to that of a partnership. So Form 1065 would be the prevailing tax form. And it gets taxed just like a flow-through entity in that there's no entity-level tax. And so the members get a Form K-1 that then gets reported on their individual tax returns just like a partnership. And again, the income is potentially subject to self-employment tax just like the sole proprietorship, just like the certain types of partnership income. There may be state-level filing requirements based on the jurisdiction you're in and those laws of that jurisdiction. Some states don't respect it, the LLC. Some states and cities do. Some states tax LLC income differently based on the type of business activity it is. So this is where working with a qualified service provider that understands the state issues could help you navigate the type of entity, where and how to file, how to even record the income so you're reporting as favorably as possible in those jurisdictions. And so a lot of that just depends on how the independent contractors are deriving their income and the type of consulting that they may be providing.
Okay, so even though you shouldn't just go say, "Oh yeah, okay, I'll just go set up an LLC." You really should talk to a tax accountant and an attorney for your city and state to understand, like, and based on what kind of activity you're going to do, to really understand if it's the right, setup and entity type, and if so, where you should set it up. If it should set up for your home state, Texas, Delaware, Nevada, etc. It's not just sort of an obvious, like, oh, just set up an LLC.
Something that just occurred to me is just because someone, let's say, sets up a Delaware LLC and they're still operating their business in New York, it doesn't remove them from the obligation to pay New York State income taxes and any local filing requirements that they have. So just because the legal form is in a jurisdiction that's away from the home jurisdiction, it doesn't alleviate the taxpayer from any resident state filing requirements. This is just where the legal form is and what state laws are governing the operation of that business. Again, outside the scope of what we're talking about here, but you could have a New York-based business with a Delaware LLC, and then you could have a New York-based business with a New York LLC. And again, each one is very different in terms of filing fee requirements, legal protections under the Commerce Act, anonymity issues, but it does not take you away from any filing obligations and tax payments that would be due on your sourced income anyway.
Yeah. I think one takeaway from this is, I just want to make sure I got it, it's that for the most part, unless there's something unusual about your city or state, for the most part, whether you have a sole proprietorship with no entity type or you have an LLC, if you're a single member LLC, end of the day, your taxes should be the same because it's a flow through entity. So just the LLC would give you that added liability protection, but from a tax perspective, it's going to be the same at the end of the day.
Well, let me throw a wrinkle in it too.
Of course.
You could actually be an LLC or a partnership at that, and you could make an election to be taxed as a C corporation. So the legal form is still the limited liability company, but you could elect to be taxed as a corporation. Again, beyond the scope of this conversation, and there are several reasons why certain folks would elect that, but so it's not always the case that it's going to be flow through taxation to the individual. There are situations that you could, if you're conducting business as a limited liability company, you could actually choose. You could be a disregarded entity if there's one member. You could be taxed as a partnership if it has more than one member, or you could be taxed as a corporation if you make that election.
Okay.
So that's why most practitioners would say that the LLC has the most flexibility, because you could be taxed as a partnership or a corporation. There's a lot of flexibility on what jurisdictions you form under. So it's a very powerful entity when you have good advisors helping the owner.
Okay. So you could choose as an LLC to file your taxes as a pass-through or as a sole proprietor, in which case it would be identical, but there are also some other choices that are out of scope. So let's go on to S Corp. So S Corporation, what are the formation requirements for an S Corporation?
Yeah, so now we're starting to get into the second most common question I get is, do I want to be an LLC versus an S Corporation? S Corporations have been around for ages. And for a time, they were the most common entity for that independent folks and even small businesses were structured as.
What's the S stand for?
Subchapter S. So there's a part of the tax code that governs these types of entities, and it's chapter S.
So it doesn't stand for it's just sort of a letter in tax code. It doesn't stand for something.
That's right. And Same thing. A C corporation is subchapter C.
Okay.
Where if you set up an S corporation, you're considered a shareholder and not a member. You don't. Interestingly enough, you don't set up the S corp right away. You actually form a C corporation, and you make what's called an S election. And this is a federal election. Some states you have to make a state level S election, and you also have to make sure when you do it for federal, you have to do it for the state. So you normally would form as a C corp, which is a state level. You would file with the state. You file with the Secretary of State, do the articles of incorporation, have minutes of meetings, have officers, file that, pay the fee, and then once you get it back from the Secretary of State that has accepted your application to form a C corporation, you would then make what's called an S election. And you make that on Form 2553 with the IRS. It needs to get done within a certain amount of time. And then the government almost always says, okay, we've accepted the fact that now you are electing to be an S corporation. Okay. Generally, there's, again, corporate liability protection. So the shareholders are typically not liable. So they also have limited liability. Because the S Corp is what's called another flow-through entity, so like an LLC that's taxed as a partnership, and like partnerships and sole proprietorships, the S Corp files a form called Form 1120-S. The individual owners or the shareholders of that S Corporation get a Schedule K-1, just like the partnerships and limited liability companies that have more than one member. They take that K-1 and report it on their individual tax return. So very, very similar to that respect as well. Now, there are other little complicated nuances. You can only have one class of stock as an S Corp. Most independent contractors, that's okay. You can only have 100 shareholders, which could only be individuals in certain estates and trusts. You can't have any non-U.S. citizen shareholders. And those are generally the three main issues with an S Corp. Now, why would I want to be an S Corp versus an LLC? Great question, Will. As I mentioned before, at the LLC and the partnerships, your net income is subject to self-employment tax. So if I make $100,000 and I have some expenses and my net profit after expenses is, let's say, $80,000, that $80,000, while subject to income taxes at my highest marginal rate, is also subject to the 15.3% self-employment taxes. Let's flip to the S Corp for a moment. Generally speaking, there are two ways an S corporation can pay himself. Through distributions, and that distributions of income and profits are not subject to self-employment taxes. The other item is salary, which is subject to self-employment taxes. So if you set up an S Corp, it's as if you are the owner and the employee of that company at the same time. So S corporations generally have to pay themselves what's called a reasonable salary. That is a term of art. There are several court cases that have talked about this, but generally speaking, reasonable compensation is the amount of compensation that a similar business in a similar demographic, in a similar geography, pays their owners. So for example, let's say it's $100,000 of your gross income. And let's say studies show that, okay, you know what, $20,000 is reasonable compensation for owners of this type of business with this income level. So the owner of that S Corp gives himself a $20,000 W-2, has federal withholding, sometimes has state withholding, has his share of has Social Security and Medicare taxes on it. The company gets a deduction for that. And so let's say after paying that payroll, the company now has a net profit of $80,000. That $80,000 that gets taxed on the individual tax return is not subject to self-employment taxes, but the $20,000 W-2 is. So that $100,000 that would have been fully subject to self-employment tax if it was an LLC or a partnership, that same amount of money earned in an S corporation that pays a small salary what's left over is not subject to self-employment taxes. So, which makes S corporations really, really powerful, because there is a potential to save a considerable amount of money on self-employment taxes, because the net profits are not subject to that additional 15.3% tax.
Okay, I got a question on this. So
Yeah.
let's take a slightly different example. Let's take an independent consultant who is, is billing, let's say, $250,000 a year. Okay. And they're thinking about, should I set up an LLC, perhaps? But they say, okay, they're evaluating an S Corp. So that person, at a slightly different, kind of, income level, perhaps, I don't know what their reasonable, quote unquote, salary would be, but doesn't the self-employment tax phase out at some point? I don't know, like 100,000 or 110,000 or something, and then anything.
So there is, that's a great point. Let me just pull up what the 2020 rates are.
Because the question in my mind, Jonah, is, let's say you're billing, I don't know, 250,000, and maybe you could say your reasonable salary would be maybe 150,000. So it may be the case for some people, if you're earning enough income, that the reasonable salary that you're going to pay yourself is already above that phase out. So then maybe the S Corp would not actually make a difference, because you've already paid the full amount that you're due.
So that's a great question. So generally speaking, and again, I'm doing air quotes right now, a lot of folks think a third is reasonable. Some businesses, let's say, for example, and I'm going to say something that's controversial here. There are some folks that believe, okay, let's say if you're an author or you're an artist and you're structured as an S Corp, really 100% of your earnings should be wages, right? Because you are the capital-intensive resource that generates the income. Whereas if your business is very much capital-intensive on fixed assets, maybe you can make a case that not 100% should be waged out. Again, beyond the scope of this discussion. But you could be okay with a third. Now, you mentioned about the maximum. The payroll taxes cap on maximum earnings for 2021 is $142,800. The Medicare has no limit, right? So you're going to pay FICA of 7.65% plus another 7.65%, right? That's the 6.2 for the Social Security and the 1.45 for the Medicare on the first $142,800. And then the additional, 1.45, there's no cap. And then there's also an additional 0.9% Medicare taxes on folks that earn over, if they're married, $250,000. So if the reasonable comp happens to be over that max, you're still going to only pay the Social Security on the max, and then the Medicare, the small percentage on the full amount. Now, keep in mind, you get the company's going to get a deduction for the wages, and it's going to get a deduction for one half of those payroll taxes as well. So that $250, and let's say we say, it's $75,000 is the reasonable amount of gross wages. So the $250 gets down to, the $250 goes down to $175, plus another deduction for the Social Security and Medicare taxes. And so let's just say it's another, let's say $15,000. That $160 is not subject to any more self-employment taxes on the individual tax return. The taxpayers only paying the payroll taxes on what they're getting a W-2 on. So in that respect, there's a tremendous savings by being an S Corp than an LLC. What I didn't discuss, which is important to mention, is that some states don't accept this S corporate form. So let's take New York State. There's New York City, let's say. New York City does not respect S Corps. They're taxed as C corporations. So there's an additional 4% tax at the city level for contractors operating as an S Corp in the city. They're getting taxed at 4%, an additional 4%. So there's a little bit more analysis to get done between the advantages of an LLC versus an S Corp, and a lot of it is related to how much gross income the consultant is scheduled to make, what jurisdiction they're in. But generally speaking, S Corp can be thought of as being generally more favorable from an LLC. Now, there's also kind of two broad academic points that people like to mention. An S Corp is easy to set up and generally inexpensive to set up. An LLC is a little bit more complicated to set up and a little bit more costly to set up. However, while the S Corp is easy to set up and cheap to set up, it's a little bit more costly to maintain and administer because you need separate books and records generally, and you have to file separate income tax returns. You're filing separate corporate returns. If you're a single member LLC, while it's a little bit costly to set up, it's very easy to maintain. There's no separate income tax returns. Everything gets reported on the individual taxpayer's return through their Schedule C. You should keep separate books and records, but a lot of folks sometimes don't.
Now I'm surprised that you said it's expensive or complicated to set up an LLC. I thought it was pretty straightforward.
No, it's no, because remember it's governed by the state, right? And so usually you could go on like for example in New York, there's a rather lengthy process, and individuals could do that. You need to advertise in a paper in New York State, which generally gets costly. Some states don't have that requirement. S Corps don't have that requirement as well. And the fees to set up an S Corp in New York State are much less than the LLCs.
No kidding. Okay.
To actually create the legal entity.
All right, but I thought like you could go to some of these, you can just Google like set up an LLC, and you get all these different websites that'll do it for you, LegalZoom or whatever, and it's like a couple $100 to set up an LLC. I thought, but maybe,
Yeah, I would not recommend that, because there could be legal issues. While I have no problem with those websites, it doesn't take into consideration any nuance or complications or any alterations that should be addressed. Sometimes we like to put certain provisions in the agreements that offer some flexibility on transfer, on distribution of income and deduction and losses. I would always recommend using a professional service provider outside of some of those services, especially if there's a chance that things are going to be a little bit more complex down the road. Sometimes cheap gets expensive, and not that these guys don't do a fine job for most people, but I find it better in most circumstances to make sure you have an attorney and a professional service provider assisting in that process.
Yeah. How much should you expect it would cost to set up an LLC? I'm sure it varies a lot based on the state and so forth, but like order of magnitude, is it a couple $1,000?
Look, it depends on the state, and it depends on the attorney, and it depends on the type of business. I've seen attorneys do it from anywhere from $500 up north of $5,000. Now, keep in mind, there's the attorney fees that need to be considered, and also the state filing fees. So again, New York has its own fees. I haven't checked in a while what the New York fees are, but there's also the advertising requirement that New York State has on their LLCs, which could be $2,000-$3,000 as well. And that's the attorneys don't have any negotiation power in that. That's just what it costs to publish it in the paper. S corps are again rather inexpensive, but again you need to have meeting minutes. You need to elect a board of directors. There's a lot more formality around establishing an S Corp that at times the limited liability company does not have. So I hate to use such a broad range between the $500 and $5,000, but it really can swing that much. You could have a local independent attorney that's just himself, that just does corporate formations, that could do this rather quickly and inexpensive. Or you could use an attorney that's with a large international law firm where their bill rates are $1,000 an hour, and it's going to cost you an arm and a leg. So it really just depends. Now, I will say as well, for the S Corp, there are a lot of free resources outside of those services that can be done on your own. You don't always need to engage an attorney or a CPA to do it. The New York State website has very, very easy steps on how to establish an S Corp and how to establish a C Corp and make that S election. If you follow through the steps and do it very methodically, it's rather easy. So that it shouldn't discourage contractors from doing it. Now, that's not to say that, look, are they in an adverse position if they use those online services? No, but I think it doesn't afford the flexibility to customize the agreements based on individual circumstances, at least from my experience. And again, I don't want to disparage those services because I know clients that have used it in the past and have been happy, but that would not be my first go-to recommendation.
Right. And I think there's a distinction between actually doing the filing with the state versus the operating agreement. And definitely with the operating agreement, you want to get an attorney, particularly if it's something other than a single member LLC. And to mention, just to build on your point about publishing requirements, New York State is one of only 2 or 3 states that have this kind of antiquated requirement. I did it a few years ago in New York State, and I think it was about $1,500. And I'll look up the name of the firm that we used and include that in the show notes for this. There's only a couple states that require that.
It's a way for them to make some money, to be honest with you.
Yeah. And it's sort of antiquated, and there's probably just not enough of a people kind of advocating for them to cancel that requirement, or most states have. So it sounds like the biggest difference between an S Corp and an LLC practically is, in terms of just practical terms for one individual, would be this issue that an S Corp potentially could help you save some money potentially on the Medicare and the Social Security. That seems to be practically the major difference between those two, because you're paying yourself this reasonable salary and so forth. Would you agree that that's like the major practical difference between the two?
Yeah, I think so, Will. Without getting overly complicated, but that is generally the most favorable, is that the savings on self-employment taxes, and it can be rather powerful, for sure. I would say, yeah. The downside is, for folks just starting out that want to save in taxes, the tax benefit may be lost because they now have to, pay for another tax return now, right? Because now you have to file the S Corp return for the federal government and whatever state jurisdiction you're in. So, if let's say you're saving $3,000 on self-employment taxes, but you have to pay another $2,000 in filing fees to prepare the tax returns, is that something that's valuable for the contractor? So something to think about.
Okay. And I believe we don't have it on this sheet here, but some people, in terms of saving for retirement, if there's one method that's available, which is the SEPIRA, where you can put away something like $57,000 a year, 25% of your income, whichever is less, and that's available. But then if you want to do a defined benefit plan, then that one, my understanding is where you can put in significantly more pre-tax, but you have to hire an actuary. My understanding is that you cannot do that with an LLC. You'd have to have an S Corp. Is that right?
It really just depends. It can be done. I've seen it done with LLCs. Again, the DB plan is certainly not for everyone. You have the amount of money that you would wind up be putting in a defined benefit plan is north of $300,000, right? And you have to fix those contributions every year. But you're right. There are administrative burdens. Usually have a pension plan expert set up the defined benefit plan. They're a little bit different from a defined contribution plan, which is, like you said, your SEP IRA, your SEP IRA, your solo 401k. But it really just depends on the level of compensation, any employees, how old you are, what your retirement costs are going to be, and it really just depends on what the specific needs are. But you could have a defined benefit plan within an LLC if the LLC allows for it. There's no specific requirements on how you set up your pension plan.
I did not know that. Okay. And let's spend some time.
And I would recommend it if folks are considering a defined benefit plan. I'd recommend hiring what's called a TPA or a third-party administrator, and they're the folks that are specifically tasked with setting up the pension plan. Because there's a lot of discrimination testing, high taxed income testing. It's a lot more in depth to administer and manage than a defined contribution plan. Anyone could go on Fidelity or Vanguard and set up a SCP or a SEP IRA or a solo 401k, a traditional IRA, Roth IRA. To my knowledge, you need external providers to establish the defined benefit plan. Defined benefit plans, while they're great, they're certainly not for everybody. They're certainly not for everyone just starting out. Usually, if you don't need the liquidity from your business and it's a considerable amount, I would generally recommend a defined benefit plan, but certainly not in the beginning where cash flow is paramount for most folks.
Let's talk about the last entity type, the C corporation.
Yeah, so the C corporation is rather interesting. And I will say again, I'm going to be giving very broad stroke advice here, but keep in mind the highest corporate tax rate was reduced a few years ago from 35% to 21%. So a lot of times the C Corp tax rate is lower than an individual tax rate. But just because the rates are lower should not mean that it's more favorable than the others. So just like the S Corp, really S Corps are C Corps that made an election. So formation's the same. State level filing, you're not making an S election at that point. Your shareholders that hold stock, so there's limited liability. Well, there's complete liability, right? Unless there's fraud. So the shareholders are veiled from any liability of the entity. The main difference here that, unlike the other four, is that tax is paid at the corporate level, at the highest rate of the corporate rate structure, which right now is 21%. Files its own tax return, Form 1120, and then any state-level corporate forms as well. Nothing flows through the individual taxpayer. Everything is taxed at the corporate level. Now, how do you get money out? So if I'm an independent consultant and I'm operating as a C Corp, the C Corp is a completely separate, sheltered legal entity. Well, there's a way to get money out. I could pay myself a salary, very similar to that of the S Corp, right? If a C Corp makes $100,000, pay myself a $20,000 salary on a W-2. That's what I'm picking up on my tax return as a W-2. The C Corp gets a deduction for the salary and the employer's share of the self-employment taxes. And then the corporation is taxed on the net profit at 21% if they're in the highest rate. Well, how else do you get that after-tax income out? Well, you could pay yourself a dividend. Now, it's generally not recommended because it's subject to double taxation, just as if you got a dividend from IBM stock. Now, dividends are taxed at the individual taxpayer's highest marginal rate as well, which could be as high as 20%, plus an additional 3.8% in investment income tax, or the Obamacare tax. So there is a possibility for double taxation on that income, where the tax rate could be almost as high as 54%, depending on what state you're in. Unlimited number of owners, and the only self-employment tax issues you have would be at the individual level with the W-2. Now, if let's say you don't distribute out as dividends, and let's say the business is accumulating income year after year after year. There is an accumulated earnings tax that gets taxed on if the C Corp is just used to build up income and never distributing it out. So that is a risk and exposure area that we advise clients on to make sure that they're taking reasonable salary from the company and or they're potentially taking dividends from the company. So on the surface, the tax rate is much lower, but there are other nuanced issues that need to be at the forefront when deciding on proper corporate form. I would tell you the C Corp is not a popular choice with independent contractors for those reasons. There are situations why it would be applicable, depending on the type of business and your liquidity needs and your risk tolerance. But generally, the S Corp and the LLC tend to be the most discussed. Excuse me.
Excellent. So my takeaway from this conversation is that this is not a simple decision, and that, even though that there are so many different factors involved, and it depends on, where you live, how much money you're making, your risk tolerance, your age, how much cash you need today, and where you're operating, where you're doing the work. There's so many different factors that it's not just a simple thing like, oh, you should just get an LLC. But really, you should talk to probably a tax accountant as well as an attorney to figure out for your situation what entity type you need. Would you add anything to that, Jonah?
Yeah, look, there's a lot of really good resources out there. The IRS has some pretty nice publications. I'm obviously always available to you and your network for guidance. Each state Secretary of State has a nice small business guide on some of these things. The Journal of Accountancy and the Tax Advisor have good pieces on this as well. I would caution against using blog posts and Google articles as authoritative. It could give a nice start point of some basic blocking and tackling that needs to get done as it relates to entity selection. But I would, take that information and then speak to a professional service provider. I think for folks that are just starting out, some of the questions they should be asking is, who am I doing business with? How am I getting paid? What's the nature of my business? Where am I going to operate? What's my exit strategy? Am I going to need to, finance my business? Am I going to take on investors? Am I going to look to hire employees or other independent contractors? Am I going to have other members operating the business with me? I think some of those boilerplate questions should be some basic questions that most of the independent contractors should be asking themselves, and that'll help steer us into the right direction on what's the most appropriate entity form. And I will say is there are opportunities to change later on. If you're a sole proprietor, you could then just form an LLC by filing with the Secretary of State. If you're an LLC and things change, you could elect to be taxed as a C Corp. Or you could even convert from one entity selection to the other, again, beyond the scope of this call. But it's never fixed in stone, right? There are ways to convert. Some are more complicated than others. Some have an adverse tax consequences than others, but it can be done. But I think, everyone needs to be a bit more self-aware in terms of what they're doing, who they are, and how they're doing it. And that will help our discussion in terms of what's the best form to structure the business as.
Fantastic. Well, Jonah, we'll include Jonah's contact info in the show notes if you want to reach out to him to follow up. Jonah, this was hugely valuable. Thank you so much for joining today.
Yeah, it's my pleasure, Will. Thanks for having me again.